So hello everyone. Today we will be explaining you about income from house property. So income from house property is one of the important heads of income under the Income Tax Act. House property means any building of which the SSCs is the owner. Ownership of the building is must in case of calculation of income from house property. A house property could be an office, a shop, a building, or some land attached to the building like a parking lot. The annual value of a property consisting of any building or lands of which the assessee is the owner is chargeable of tax under the head income from house property. So what consists of house property? A property which must be containing any building or a land. Then the basis of charge. The basis of charge under the head income from house property is the annual value of the house property, which is defined as the sum for which the property might reasonably be expected to be let from year to year. Under the Income Tax Act of 1961, the basis of charge of income tax in respect of income from house property is based on three essential conditions. First, the property must consist of a building and a land thereto. The assessee is the owner of the property. The assessee doesn't use the property for purpose of own business or profession. So basically, there are three conditions. It should be the property must consist of building, land, and the assessee is the owner of the property, and the property must not belong to any house, must not belong to any businesses, etc. Then property consisting of building and land. The term property under section 22, property should consist of any building or land, means land connected with building like garden, garage, etc. Building means a permanent structure made up of bricks, stones, concrete, etc., which has a foundation, walls, and doors. It does not include any temporary structure. Whereas land means any residential building, maybe in the form of a kitchen garden, motor garage, cattle shed, courtyard, backyard, lawn, approach road, etc. Next, the ownership with the SSC. The SSC must be the owner of the property. The SSC need not to be registered owner. Ownership include both leasehold and freehold right and includes deemed ownership under section 27. SSC must be owner of the property during the previous year. It is not material whether he is the owner in the assessment year or not. If the title of the ownership of the property is under dispute in the court of law, the decision as to who will be the owner chargeable to income tax under section 22 will be the income tax department till the court gives its decision to shoot file in respect of such property. The property should not be used by the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to tax. The income earned by an SSC engaged in the business of letting out properties on rent would also be taxable as business income and not as income from house property.
Yes, I'm Ronak Agarwal and I will be sharing a short summary on deemed ownership. So sometimes a person is treated as the owner for tax even if they don't legally own the property. Let's take an example. If a property is given to a spouse or minor child without proper payment, the giver is still taxed as the owner. Member who gets flats from cooperative society or company are also considered owner. Similarly, if someone get possession but the sale isn't complete, they are the deemed owner. Now I will be moving to uses of house property. House property can be used in many ways, rented out for living or for business. Any rent earned from such property is taxable under income from house property. This rule apply even if the property main use is buying, selling, or trading buildings as a business, or if the property is acquired through money lending. No matter how the property is used, residential or commercial, rental income is taxable under the header. Now, the exception to this rule. There are exceptions. If the owner uses the property only for their own businesses or profession, the income is not taxed under house property. Instead, it is treated as business income. If rent includes charges from assets like furniture, security, power backup, called composite rent, the tax treatment may change. If the building rent and asset changes can be separated, only the building rent is taxed under house property. If not, the entire income is treated as business from other sources. Special cases like hotels or property let out to employees can be exceptions to the standard rule.
Now I will be speaking about when unrealized rent shall be excluded. Unrealized rent which the owner could not realize shall be excluded from the rent received or receivable only if the undermentioned conditions are satisfied. First one is the tenancy is bona fide. Second one is the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. Next one is the defaulting tenant is not in the occupation of any other property of the assessee. The last one is the assessee has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent or satisfies the assessing officer that legal proceedings would be useless. Now let's talk about municipal tax or property taxes. Municipal tax includes services related to tax like water tax, sewerage tax, which is levied by any local authority in respect of any house property to the extent to which such taxes are borne and paid by the owner. And also it shall include enhanced municipal tax finally determined on appeal and payable by the assessee. Property taxes are allowable as deduction from the GAV subject to the following two conditions. First one is it should be borne by the assessee and actually paid during the previous year. It can claim as deduction only in respect of let out or deemed to be let out properties. Third one is deduction is allowed in the year of payment only. That is, municipal tax paid in advance is not allowed as deduction. Where the tax on property is enhanced with a retrospective effect by the municipal or local authorities and enhanced tax relating to the prior year is demanded during the assessment year. The entire demand is deductible in the assessment year.
Hello. So now we will understand the tax treatment of composite rent. Sometimes rent received is not just for the building, but also for other assets like furniture, equipment, etc. This is called composite rent. Now, basically, there are two conditions, when separable and when not separable. So let's understand when separable. If rent for property and rent for other assets can be separated, then the portion related to the property is taxed as income from house property, and the portion related to other assets is taxed as business income or income from other sources. And when not separable, if rent for property and other assets cannot be separated, then the entire income is taxed as business income or other sources not under house property. Uh, so let's understand the concept of deemed to be the calculation for the deemed to be let out property and let out property are same. For the calculation of let out property, first we have to calculate the expected rent. For that, we have to take the higher of the fair rent or the municipal value, and then we have to compare it with the standard rent. Whichever is lesser, we have to take that figure and compare it with the actual rent, and that will be the gross annual value. And then we have to less municipal taxes, then it will be net annual value, and then we will deduct standard deduction and income on borrowed capital. Then it will be calculated as income from let out property.
Now, let's sum up what we have learned. So basically, there are three types of house property. One would be the let out property, the second would be the self-occupied property, third, namely as deemed let out property. So deemed let out property is basically when an SSC is having more than two houses, then the additional houses have to be considered as deemed let out property. So for the calculation of house property income, we have to segregate the houses of the SSC into three heads, the given heads. Now, to calculate the actual income, we'll compare the fair rent municipal valuation, whichever is higher. Post that, we'll compare it with the standard rent. Whichever will be the lower will be considered as the expected rent, post which we'll compare it with the actual rent which is received by the SSC. Whichever will be the higher will be considered as gross annual value. From that, we'll deduct the municipal taxes as explained by our teammate. Then we'll get the net annual value. Post which we'll be having, we can claim deduction under Section 24. The Section 24A deduction is for standard deduction, that is 30% of NAV. And the another deduction is interest on borrowed capital, which it is basically any interest we have paid to get the money to construct the house property. After getting this board deduction, we'll get the final income from house property. This will be chargeable in our main total income tax liability and tax calculation. Now we'll go up and solve one question of house property to get a better understanding of this. So here we have a question which says that Anirudh has a house property whose municipal value is 1,30,000 per year. The fair rent is 1,10,000 per annum. The standard rent fixed by the Rent Control Act is 1,20,000. The property was let out for 11,000 per month throughout the previous year. Unrealized rent was 11,000 and all the conditions has been satisfied to recover the unrealized rent. Now he paid the municipal taxes at the rate 10% on municipal valuation and interest on borrowed capital was 40,000. So let's solve this question. So first we'll take the municipal valuation and fair rent. Now we'll just take the values 1,30,000 and 1,10,000. Now in this we'll take whichever is higher. So in this case it is 1,30,000. Now going further, whichever is higher to be considered. Now we'll compare it with the standard rent. And whichever is lower to be considered here. And standard rate in the given question is 1,20,000. So here in this case 1,20,000 will be called as expected rent. Now the actual rent, that will be 11,000 into 12 months minus the unrealized rent, which is basically 1,21,000. So in this we have to take the higher value, which is 121. So this value is our GAV, gross annual value. Now the municipal taxes, that was 10% on the municipal value, which is 13,000. So we'll deduct it. We'll get 1,08,000 as NAV. Now deductions under section 24. The first one is 30% of NAV, which will be 34,000, 32,400. Another will be interest on capital borrowed, which is 40,000 in our case. After deducting both the values, we'll get 35,600 as income from house property. So this is a full-fledged question where we calculated an house property income based on given situation in the question. That's it from our side. That's for our presentation on house property. Thank you.